So Ramsey, let's shift to part two of our conversation about Evergreen Services Group and your role in the market in terms of acquiring and building even more successful MSPs. What do you look for in terms of the KPIs or the key indicators within an MSP that you're evaluating for a potential acquisition? What's important to you?
Yeah, sure. So there are a number of things, but there are a few must-haves for us right out of the gate. I just talked quite a bit about recurring revenue, so obviously that's important to us. Generally speaking, with very few exceptions, we look for at least 50+% of the revenue to be recurring. I think across our group of companies, the number is at 60-65% recurring revenue.
Mm.
And that's, we talk to a lot of folks. That's the number one reason that we pass on businesses is because, maybe they're a VAR that's transitioning to an MSP and hasn't quite made that transition yet, or maybe they're more focused on project labor or T&M work. That's the biggest reason why we pass. Obviously, they need to be profitable, and with very few exceptions, growing. Our group of companies is growing at 20 to 30% on the recurring revenue front year over year. So we focus on growth in recurring revenue in particular.
Mm-hmm.
So those are some high level things that, when you have an initial conversation with a business owner,
Let's drill down in a couple of those KPIs. The recurring revenue, obviously important, but are you looking for a certain amount of profit coming from that recurring revenue? The figure I've heard, and I'm not saying this is, written in stone, but I hear best in class MSPs are basically generating profit margins of 20% or more. I mean, is that sort of your stake in the ground for what you're looking for, or can the number vary?
The number varies quite a bit. I think you're exactly right. We see kind of 15 to 20% EBITDA margins as right down the fairway.
Okay.
You start to get well above 20, and we've seen MSPs honestly that have 40% EBITDA margins. Not that's not very common, but we've talked to a handful of them. And they can be really good businesses. I think, the reason we like to see margins in more of the 15 to 20% EBITDA range is because generally it indicates that there's enough investment in growth and in the business, and there's, once the business has reached a certain size, there's a real middle management layer, and it's not being driven by the owner. I think we get really concerned when we see a business that we feel like is over earning, because we know that under our ownership we're likely to see margin compression over our ownership of the business. But we do like businesses with healthy margins, so 4 or 5% EBITDA margins can be tough. So you're exactly right. Kind of the 15 to 20% is what we consider best in class, but also healthy.
Gotcha.
Try to grow the businesses post acquisition.
Mm-hmm. So, there's the dollars and cents of all this, but there's also the cultural fit. Are there certain types of executives and or owners that you're looking for as you evaluate the market for potential acquisitions?
Yeah. I think at the end of the day, we make an investment decision largely based on the owner, because we get to spend very little time, if any time, with others in the organization. So it's really about understanding the owner from a cultural perspective. And I think the biggest thing, we look for sellers that really care about what happens to their business and their people and their clients post acquisition. We feel like we have a good value proposition to those customers, or into those business owners in particular.
Mm-hmm.
And you can generally tell just by the way someone talks about their business. If when you're talking about an acquisition, they care a lot about what happens to their people, and they're asking a lot of questions about, hey, what happens to the people, and can I talk to a business owner that sold to you guys and understand how that went for them. Those are sellers that that we like to partner with, and generally, you know, have good cultural alignment with us.
Mm.
If we have someone that's, you know, exclusively focused on, you know, the valuation and doesn't care, you know, whether half their team gets laid off after the acquisition, that'll generally be a challenging thing, because they'll ask us to assume a lot of synergies and a lot of cost reductions, and that's just not our model.
Yeah.
We generally retain all the employees in every one of our acquisitions.
Got it. And then there's the cultural stuff. And are there any yellow or red flags that you look out for? It could be cultural, it could be finance, could be the way they manage their books. I mean, what is it that says, what's an aha moment for you where you say, you know what, maybe this isn't a fit for us?
Yeah, I mentioned the over-earning point.
Mm-hmm.
EBITDA margins that are too high actually get us probably more concerned than EBITDA margins that are too low. That's the first one. The other one is if there's a lot of recent one-time revenue, in particular project revenue, that's driving up profitability, and we see a recent spike in profitability, and then all of a sudden the person is going to sell their business, that's a red flag for us, particularly on the project revenue side, because you know, T&M and project work can be very high margin. So if you're basing your valuation off of EBITDA, someone could go out and do a bunch of projects, and then look to sell the company off of what is really an inflated EBITDA number based on kind of the structural earning power of the business.
Mm-hmm.
So that's probably the biggest red flag that we look for. We also look to see, you know, is that project revenue, if there is an increase in it, is it coming from, is it spread pretty wide across the base of customers, or is it a single, you know, one or two projects that were, you know, with one or two customers that are unlikely to be repeated?
Yeah, got it.